Welcome to this week's Ben's Market Insights. It's been a little while since we spoke and we're on the road for the next few weeks. Productivity gains are a key feature that people don't tend to talk about as much when it comes to this AI race. I also want to talk about the forthcoming earnings. I think it's a very pivotal point in terms of the AI spend and the beneficiaries thereof. Clearly, we've seen a fantastic rise in the semiconductor space and hardware. We have seen a slight breakdown in that in the last couple of weeks with the SMH, which is the semiconductor ETF, down some 12 or 13% in that time. We'll talk a little bit about that and what the next beneficiaries could be and how these earnings could show up as a very seminal point in terms of where next, if you like. Before I do that, please jump onto our YouTube channel and subscribe and give us a thumbs up and a like. Thank you very much. Also wanted to highlight the fact that we've got the founder and CEO of Harrod Associates, an investigative platform and asset tracing business run by Martin Dubby, a business called Harrod Associates, as I say. And he gives us some really interesting insights into how you trace assets in this modern day age of AI and crypto and virtually untraceable assets out there, given the under-resourcing that major law enforcement authorities around the world are struggling to find these fraudsters. But Harrod is one of the few that has created an incredibly interesting technological platform in order to do this asset tracing and have found in excess of $3 billion since their foundation back in 2010. So back to this week's narrative. I do think that clearly we discount the productivity argument when we talk about the economics of AI. I think that's going to play a really major part and add some, or take away rather, some 100 to 150 basis points of potential inflationary pressure. So long and short, I believe that we will go forward over the next 2 to 3 years with what should be higher inflation, but actually dampened by these gains that we're beginning to see already. But at the same time, interest rates are likely to stay relatively stable, not falling, but not rising either, as consensus, I think, leads us now to believe that the market does not now believe that interest rates are going to be going higher, which I believe is correct. Now, the semiconductor industry has benefited from the spend of some $700 billion this year and potentially up to $1 trillion in capex into AI next year. They are the ones who are getting the first taste of those orders coming through. It's the hyperscalers, AWS and Amazon, like Azure and Microsoft and Google, that have suffered the consequences of that because they are the spenders. And of course, markets rationally took it that the semiconductor industry has performed incredibly well, in some cases like in Intel, up some 300% so far this year, whilst the average of the Mag 7 have really fallen by some 10 to 15% year to date. That makes sense, but having seen this slight splintering in this argument over the last couple of weeks with the SMH down some 12-13%, I would hazard that actually the earnings that's going to be coming up in the next couple of weeks are going to be really important in telling us if those hyperscalers, if those spenders on AI are beginning to get some kind of return on invested capital. Now, I think a lot of these guys have spent money more than they probably would have done on a FOMO basis, fear of missing out, i.e. that they feel that if they hadn't spent that money, then the other competitors will be going further and further ahead of them, and they would eventually be out of the race. And so maybe the returns on that investment may not be as high as we've seen in the past, which have been running in 15% plus type of ROIC for these big Mag 7s. But even if you assume that there is some kind of news flow that would suggest either a tapering of that capex spend, which I don't think we'll see too much of in these Q3 guidance, but I do think that we're probably starting to see some elements of the returns being generated by these companies. And if that's the case, we could see a second half of this year beginning to benefit more the spenders, who previously have been the spenders and continue to be the spenders, but now beginning to see a return, versus those initial beneficiaries, the semiconductor industry and the hardware industry. Clearly, as we continue to move forward, it's industrials, it's all users and corporates and individuals that are getting the benefit, but they are going to have to pay for that benefit in the form of token elements per unit use of AI in their workload. All of these will start to bring back, if you like, capital into the coffers of these hyperscalers. So I'm inclined to really be very sensitive to those guidelines that are going to come through, the guidance that's going to come through from these companies, and I would be inclined to start moving towards investing in back into the hyperscalers that have underperformed the SMH and the semiconductor industry and hardware in general as well. The economic consequences, as I say, I think we will see lower inflation that's tempered by higher productivity. We could see productivity gains similar to those we saw back in the sort of 2000s, when China was really beginning to sort of stress its muscles on a world trading stage and exported, if you like, the lower inflation, i.e. lower labor costs of its capabilities. That resulted in some 2.5% annualized productivity gains, and I think we're at least that again going forward at this juncture. Inflation rates, I suspect, in the US are going to be running at somewhere between 2.5% and 3.5%, putting aside this transitory element of the Iran war. We'll come back to that in a minute. But interest rates, I think, now at a point where Kevin Warsh at the Federal Reserve is likely to keep those interest rates fairly stable for the next 5 to 6 months. So I don't think we need to kind of worry too much about either reductions or hikes for that matter. But it's really all about kind of the potential black swan event that continue to be a problem at the Straits of Hormuz. We know, from our interview with Anthony Scaramucci a few weeks ago, where he pointed out that ultimately, and rightly so, that the issues around the Straits are going to continue for at least a few more months. The administration in the US is not in a position to control the narrative here. There are others at play, and it's looking increasingly likely that we saw this morning, that the breakdown in peace talks could potentially lead back into violence again. From an asset allocation perspective, we still continue to favor the US. This is where the productivity gains are going to be the most likely coming through. I certainly believe that Europe has essentially lost the AI race. There's really not an opportunity for them to come back on that. They don't have the capex capability of doing that anyhow. And so I think Europe, with its continued sclerotic growth and ossified labor markets, are unlikely to perform well. Every analyst and every strategist tells you that the Europe is set for a major outperformance. It's actually done relatively well to date, year to date, but that's really on the back of being cheap. I don't think that's a reason for investing. And at the same time, we hear that being cheap would allow for Europe to come back into growth mode. I can't see where that growth is going to particularly come from at this juncture. Further, in terms of asset allocation, we're seeing some broadening in the US market. Financials are getting a boost. The discretionary and non-discretionary consumer spend is coming through as well as in healthcare and actually biotech too. I would also suggest that whilst the US small caps have been performing well, I think that continues simply because they are really big beneficiaries of AI productivity gains. Let's remember that something that AI does is allows for automation and therefore cutting out a lot of intermediary activities, something that small caps have always been at a disadvantage to large cap businesses. Now, if you can democratize automation, clearly that's to the benefit of a small cap. So I think the small cap sector continues to outperform over the next 6 months and into next year as well. So overall, still overexposed to the US. increasing the exposure to US small caps, decreasing exposure to European markets. Never really particularly raised that position at this juncture. Interesting that the China technology sector is performing pretty well. I'm not holding my breath on that. I think there's potential regulatory overhang that could come through and cause us some problems, and continue to be relatively positive emerging markets. But let's not forget that the biggest bias and the biggest percentage exposure within emerging markets is TSMC, is Samsung and Hynix, and that has been, as I've been saying, the net beneficiary of this AI spend to date. So maybe, just maybe, we start to see a little bit of a tapering in the performance of EM versus developed markets, just because of that reason alone. I'll leave it there. Have a wonderful week and speak to you next week.